All right, Diana, thanks very much. Let's get some more reaction to that weak number and what it says now about the health of the housing market. With us on set, Don Peebles, founder, CEO, and chairman of the Peebles Corporation, privately held real estate development and investment company with residential and commercial properties in major U.S. cities, including New York, Miami, L.A., and more. Don, always good to have you with us.
Good to be here.
Let's talk about those builder sentiment numbers and how they serve as a window on the mood of the market right now. Do they?
I think to some degree, yeah. I think, well, the market is very passive right now. They're very concerned. People are reacting to interest rates, the rapid increase in interest rates, which has doubled the cost of a mortgage in about a year. And so there's some serious concern about that. I think we're going to see more and more of a slowdown in some of these key markets. I think there will be some markets that are spared, such as the Sun Belt in South Florida.
What are those key markets, and what kind of housing or residential price declines might we expect to see over the next 12 to 18 months?
Well, I think in some of the harder hit markets, mainly the Northeast, I think you're going to see prices drop well north of 20%.
Really?
Yes, because they ran up so quickly. Florida is another story. Miami, for example, and South Florida in general is supply constrained. There is tremendous demand. If you contrast it, say, to New York or California, which both have lost over 500,000 people net in the last 2 years, they've gone to
all those Californians are going to Austin.
They're going to Austin and Miami,
right,
and Dallas, and so you're seeing those markets continue to grow. While the markets have those markets appreciated very rapidly, like South Florida, particularly Miami, prices are pulling back. Their properties are staying on the market longer, but you'll see a drop down of 5%, 10%.
Interesting.
But these other markets,
we haven't seen that yet, so that it's what's coming. I thought what Diana said was fascinating about apartments. The most inventory being built now since 1973. You know this market well. Does that mean rents are going to see significant downward moves as well?
Well, no. I mean, so many of these projects were planned before the increase in interest rates. I think new construction, new apartments, owners are going to be in good positions because rents are rising in many of the key markets. And, of course, the housing market is pretty straightforward. As interest rates increase, fewer people can afford to buy. So many people are priced out of buying, or they can't buy what they thought they were able to buy or what they wanted. They're going to become renters. And so you're going to see the rental product is actually going to improve in terms of quality to replicate home ownership or apartment ownership.
So that won't put downward pressure on rents. We're rooting for downward pressure, maybe not for you, but because the renters, because of the inflation story. I mean, it would seem, that would be the obvious takeaway from this, but maybe not.
Not this year, because consumers still have a lot of money. I was at the J.P. Morgan conference last week, and Jamie Dimon pointed out how consumers are loaded. They are. All this federal money that they've received, all these benefits, and so they're spending, and they're beginning to spend now on credit cards, so those rates are going to hurt them. So by the third quarter of this year, you'll see people running out of money, and I think that'll affect consumer spending. But housing, I think, is going to hold pretty tight in terms of rental housing. Oh. So I'm very optimistic on that, especially in markets like Charlotte, the Sun Belt, Tennessee, Texas, and Miami.